Absolutely. No, and it's all about reps, man, because getting over that mental hurdle is more than half the battle, right? Trusting your TA and allowing your model to deliver over a series of trades is very difficult because we're emotional, and when we win trades, we get very happy. When we lose trades, we get even more upset. And when we're upset because we lose trades, we often tend to blame our model as opposed to realizing that it's us who are manually tampering with the model and messing it up, right? Like, for example, if you had just followed the model, which from my last lecture, which is the 5-minute market maker model, all the conditions are met. We have hourly bearish structure with this market structure shift. Then, in the New York session, what are the two conditions I look for? Do you remember? Yeah, so a stop hunt on the hourly or return to a premium PD array because I'm bearish, right? So in this case, I get the first condition, which is going to be a run on hourly high, so a stop hunt. Now all I do is I go down to the 5-minute, wait for my market structure shift, which is right here, and then enter on the first fair value gap. I tell you to risk the high of the fair value gap, that third candle, and then target the 5-minute original consolidation. Zooming out here, it's fairly clear if you can't see it. Where is the original consolidation of this market maker model? So say for example I have a whoops, that's not the thing I wanted. If this is my buy side of the curve, and this is going to be my sell side of the curve on the 5-minute, right? Where is my original consolidation, would you say, looking at this? Really terrible arcs. Yep, of the buy side, right? So this is the run up in to our hourly purge right here. So we're looking now, once we shift structure lower, right, on this candle body closure on the hourly, we're now looking for a sell program. This is the 5-minute fair value gap. Just looking at this side of the curve, which is the sell side. Where can you see obvious regions of accumulation? Do you see this kind of box in here? And do you also see this box in here? Okay, so this is your original consolidation, your first accumulation, your second accumulation is right here, right? Then we have time distortion, which I'll tell you about today, manipulation, deviation, right, out of this high, and then we have a reversal right here on the hourly. We close below here. Now, you can see the market maker sell model, right? Look at our first accumulation right here. Do you see that? This is the fair value gap that you take your entry in, because what you're entering on is the low risk entry for the market maker sell model. It's when the first set of sell orders are being accumulated. Then we distribute lower. What does this look like right here? So like I said, when you say, oh, are we going to continue moving lower or are we going to reverse here? When you zoom out and you look at the other side of the curve, does it not look like we're reaccumulating right here? And then final delivery, right? And then you can see, if you played it again in the afternoon, we had a reversal, right? An hourly low, accumulation, reaccumulation, and now we're here. So the market books in terms of these phases, right, of distribution and accumulation. So what you have to do is just trust the model to deliver. And essentially what that means is enter here and to set your stop loss and set your limits and then don't touch it. But it comes with time, right? Yeah. Yeah. It's not easy. And then once the PA hits, you get yeah. Yep. Yep. Yeah, and emotions are out of control. Emotions are completely out of control. I totally get it. Yeah, yeah, and yeah, And something I work on with some of the people I work with is specifically trusting the model, because it's always going to be yourself who sabotages. In this case, you understood the TA, right? Like, I in my last lesson, I talk about deviation projections, and I'm like, okay, if you really don't know where price is going, look at a manipulation leg into the hourly liquidity, and then take your standard deviation. You would have seen that this level here lines up like perfectly with our liquidity pool, right, of 1734 or for 14734. So without knowing anything, you could say like this is a high probability drop based on just these deviations that you learned, right? Or you could just say I want to choose swing lows. All you have to do is find some form of the model that you trust to deliver because of your back testing, and then don't allow yourself to sabotage that. So just say I'm taking partials at this swing low, or I'm taking partials at the second deviation, or between the second and second 0.5, and you hard lock yourself into those, and you don't allow yourself to sabotage. Yeah, and it just takes time. Hmm. Totally, totally. Yeah. Okay. So what we'll do for today's lesson, it seems like everyone's here, and I've recorded it for those who can't make it, is we're going to go through two concepts. The first concept is going to be something called inducement, and the second concept is going to be intraday profiles. Now, as you guys know, intraday profiles are very, very similar to weekly profiles, just for trading the lower time frames. So, you know how we often say things like Monday or Tuesday will form the high of the week, and Wednesday and Thursday may expand, and then Friday will retrace and close back in the range. That's a classic kind of buy or sell week. We can take it a step further and look for how we can trade the intraday, meaning the transition from London session to New York session, alongside that weekly profile. And I'm going to give you guys a new piece of information, which is called protraction profiles, which sound confusing, but they're really simple, which is going to help you kind of determine what that transition looks like from the London session into the New York session, and also how to anticipate what kind of price action to expect in New York. So, without any further ado, right, let's jump into that first concept, which is going to be inducement. Now, inducement, who here, by the way, has heard about inducement before? Come off mute or type in the chat if you've heard about inducement before, and then tell me what you think it means. Not all at once. Get, getting flayed. Never even heard. Cool. It's fun. PMA, what do you know about inducement? Yeah, you as well. How do I pronounce your name? I always mess this up. Jage. Okay, so Jage and PMA. You guys tell me, have you heard of inducement before? Okay. What is inducement? Okay, nice. So to suck in liquidity or to bait one side of the market, to generate interest opposing the direction of your draw in liquidity, essentially, right? Cool. PMA, what's your understanding of inducement? Manip. Yeah, it's manipulation. So I'm gonna radically redefine what you now know to be inducement. Inducement is now going to be thought of in your minds as a return to a fair value gap. Okay, whoa, that sounds weird, right? That's not what I've usually thought of inducement. I usually think of inducement as, oh, my dog just got home from a walk. We usually think of inducement as, baiting the other side of the market, generating liquidity. Yes, yes, yes. These are all true, but I'm going to teach you this concept in the context of fair value gaps. So as you can see here on the screen, here's a little schematic of what inducement looks like. But before I actually touch on why the inducement model looks like this, I think it's better to understand the difference between swing highs and liquidity pools and fair value gaps, because then you'll really understand how the market makers, right, or the institutional price delivery algorithms really use this idea of inducement. So let's define inducement as generating liquidity in the direction opposing the draw on liquidity. Right? And the draw on liquidity, if you guys came to my last lecture, is going to be your higher time frame draws. So for example, today, our draw on liquidity, looking at the hourly chart, is going to look something like these swing lows, because we have a bearish market structure shift, we have an hourly stop hunt, and then we have a 5-minute distribution to these hourly lows in the form of a market maker model. That's the model I've taught kind of before. So we'll stick with that context for looking at higher time frame delivery and targets. The draw on liquidity. Again, if you missed my last lecture, what I usually do is I start on the daily chart and I look at the draw on liquidity as a concept from inefficiencies, right, to liquidity pools, and then liquidity pools to inefficiencies. So I won't recap the last lecture. You guys can watch it after. But as you can see, once we trade in to this daily fair value gap, my target now on the daily time frame, right, is going to be this swing low down here, which you can see we put in a failure swing actually on Wednesday right down here. So the market moved from this inefficiency down to this low. Okay, that's kind of the draw on liquidity. So let's go back to what inducement is. I'm sure there's no question. Okay. So what I'm teaching you now is inducement is going to be generating liquidity in the direction opposing the draw. The question I have for you guys is, if we look at a chart like this, above this high right here, can someone tell me if smart money is accumulating orders, right? Or if smart money is inducing price? What are they doing more of above this swing high? Someone take a stab at that. The first, accumulating orders. Tell me why, Jimmy. Buying on the cheap. Yeah. So if you just use the simple concept of stop losses and buy stops and sell stops, you'll be able to understand this concept very clearly. So when I am short the market, right, as a retail trader or another, hedge fund or something that's not the algorithm we refer to as IPTA, I am placing a buy stop above this high. So above this high on the hourly chart, right, which I teach you to use for your structure time frame, there is going to be resting liquidity, meaning everyone who's net short the market will get liquidated above this high. But when we think of what liquidation really means, let's take a look at what the word buy stop means. Buy stop means that you have sold to open and you are buying to close, meaning if someone here is filling your order and you are buying to close, what does that make them do at this point right here? If you are buying to close because you have a buy stop, who must fill your order and what must happen here? Someone tell me. Anyone in the chat? Yeah, there you go. Yeah, perfect. So the role, right, of the central bank and the role of the institutional price delivery algorithm is to provide liquidity and fair value in the markets. So if we want to be stopped out, which obviously we do as traders, we wouldn't want to come up here and not get our order filled if we were stopping out. Someone or something, an entity known as smart money, is going to be actively selling to open because you are buying to close. This right here, guys, is a concept known as order pairing. Now, order pairing is simply the offset accumulation of orders. So what rests mostly above this high? There rests a lot of buy stops. So the counterparty, right, liquidity order is going to be selling positions. So above this high, we have offset accumulation where smart money is soaking all of these stops. So as price drives into this specific high, right, there's the liquidation of all of our stop losses, and they are actively selling to open those positions, entering net short the market, which allows us to get filled and subsequently gives us the signature in price, which is displacement, right? At this specific high, let me sync this and then get rid of this. Oops. Okay. At this specific high, right, the buy stops of retail traders and other algorithms are being absorbed, soaked, and then the market is displacing lower because there is an influx of sell orders in the market. That means smart money is showing you and tipping its hand that there has been some form of offset accumulation here, okay? Now, this is such an important concept when you compare it with what is happening in a fair value gap. So can someone tell me what they think is happening in a fair value gap? Is there resting stop loss? Okay, here's a question for you guys. Say this is the 1 minute chart. Would you ever put your stop loss, Jage, would you ever put your stop loss in the middle of a candle here? Like, there's a fair value gap in here, right? Right here. Would you put your stop loss right here? Probably not, right? If you were, and you have to think like the majority of traders, institutional and not institutional, you place your stop above structure. So above swing highs, there exists buy stops, and below swing lows, there exists sell stops. I promise you I'm not rambling, right? This is actually what inducement truly is. So when the market is trading back up into an inefficiency, right? Is the market really stopping out any players? Is there offset accumulation happening in here in the same way it happened above this high? Yes or no? Everyone say it in the chat. Everyone vote in the chat what they think. Is there the same level of accumulation happening in this fair value gap for smart money shorts that there is above this high? Is there offset accumulation in the middle of this inefficiency? No. Sorry, no worries, Mike. But is smart money soaking orders here? Yes. Yes. So what I want you to think of now is reframe the way you think of fair value gaps, and you'll see the market differently. I want you to now, Jage, think of swing highs as the point or the origination of smart money offset accumulation. This is where they're soaking your buy. So say you got stopped out, right? This is where they're physically buying your stop loss. Make sense? Because they have to fill your order, correct? You need to get your stop loss filled, so someone has to fill that. You probably don't have your stop loss in the middle of this fair value gap. So what is the reason why they are returning price to this fair value gap? There's no stop losses in here. People don't have their stop loss in here. So why is smart money returning to that fair value gap? The answer is inducement, okay? So now you're thinking about fair value gaps as not areas where smart money is trying to accumulate more orders per se. It's areas where smart money is trying to induce the other side of the market. What is this right here? Can someone tell me what this line looks like? Is this low or high resistance liquidity? Everyone say it in the chat. Low or high resistance liquidity? Right below all of these lows, which trade into this inefficiency. Low resistance LRL. Jimmy, why is it high resistance liquidity? Climbing. So I'm going to teach you a concept quickly called high and low resistance liquidity. Every time you see a failure swing, Jimmy, so if you see something like this low is lower than this low, which is lower than this low, which is lower than this low, which is lower than this low. All of these are failure swings, and they're actually low resistance liquidity, meaning if you were long the market here, Jimmy, would you get stopped out right here at this candle low? Yes or no? If you were long the market, this low, would you get stopped at this next low? Yes or no? No. Okay, perfect. So embrace the mentality that the vast majority of stop losses, right, are centered around swing lows and swing highs. So when we see something like this is going to be our LR signature, right? This is going to be trend line liquidity. What we're doing is we're inducing, right, the other side of the market. Inducing is a return to a inefficiency. In your mind, you're going to start thinking about this now. You're going to be looking for these signatures. How do I know price will sell off in this fair value gap? I'm thinking about the concept of inducement actively. If I am seeing price do something like this leading into the fair value gap, where it comes down, then it comes up, then it violently moves back down, then it comes up into the range, chops around, goes down one more time, and then comes up. This is not low resistance liquidity. This is high resistance liquidity because this low, right, is higher than this low, and this low is higher than this low, meaning everyone who was net long the market here gets stopped out. Net long the market here gets stopped out. Net long the market here gets stopped out. This impulse, right, coming back into the fair value gap is lower probability because I haven't seen my inducement signature, which is going to be low resistance liquidity. Don't believe me? Just look at this on the hourly time frame, okay? Look at these, look at this right here. Okay. This right here is a large form of hourly low resistance liquidity. It's failure swings. We're putting in higher lows, which is normal. That's market structure. But what we want to look for, right, is the point at which a fair value gap is creating this signature, right, which we're now going to consider inducement. So in my channel from earlier, I think today I posted it. I'll take you through this example. You see that we have this kind of signature happening again, where we have this is actually an SMT with the S, but we have generally these low resistance liquidity ranges forming. And the same thing happens today, right? We have this large trend line that's broken. This is what we're going to teach you in terms of the concept of inducement. So to crystallize everything I just said, to make it clear, a return to a fair value gap is not smart money absorbing more stop losses. There is no buy stops here. There isn't. In the middle of the fair value gap, no one's putting their stop loss. They're putting it here at this swing high. But what does exist in this fair value gap is inefficient delivery to one side. So the reason why ICT teaches fair value gaps as something called SIBIs or BISIs is because this one candle has delivered only the sell side. So the algorithm is repricing the buy side for the reason of inducement. Does that make sense to everyone? If that doesn't make sense, let me know in the chat right now. Does that kind of make sense? Yes, no? Yep. Okay. Yep. Awesome. So what we're going to think of now moving forward is a return to a fair value gap is inducement because there is no stop losses in a fair value gap. What there is inefficiency, and the price wants to be delivered efficiently. And the reason why, right, ICT calls it a sell side imbalance, buy side inefficiency, is because sell side has been delivered, right? And buy side needs to be re-delivered before sell side can be delivered again. So what the market wants to do is it wants to paint in this area of inefficiency, right, with buy orders, not for the reason of stopping traders out. That's very different than this high. At this high, the market is driving above there and pushing above to stop you out. And what it's doing is it's absorbing your stop loss and it's shorting the market. It's immediately filling. So the minute it trades above this high, as you can see by the candle bodies, high frequency trading algorithms above this high are shorting the markets in thousands of orders because all of the stops that rest above this high right here, this high right here, and this high right here, right? Or any of these highs in here on lower time frames, all of those highs are now being liquidated by smart money who's reversing price and sending us lower. In this fair value gap, what they're doing is they're enticing the market to go long, right, by creating low resistance liquidity before they sell off again. So I want you to study now when you're back testing this signature leading into a fair value gap. It is a great signal for what the true narrative of price is. So you see, this looks incredibly maybe bullish on a lower time frame, right? And many people would be induced into this long because look, we have an ICT model, right? We have sell stops right here below this low. Then we have a market structure shift above this high. We have a return into this order block or this fair value gap, and then we're pushing up. And even here specifically, we have another market structure shift. What you have to recognize is that this signature here, right, in context of the higher time frame draw, right, which is going to be your draw on liquidity, which I talked about in the last lesson, is just creating, right, failure swings leading into the inefficiency. Okay, so to crystallize this in a schematic, let's look at what this looks like. And you'll see this pattern repeat. We have some form of manipulation above the range, which signals smart money reversal. This right here is where smart money is going to be buying, right, or selling your buy stops. They're going to be filling your orders, reversing the market because they are the counterparty to your buy stop. All of your stop losses are above this high, they're soaking it, and they're pushing price lower. Then what they will do is they will often generate a form of low resistance liquidity right before, right, or right above or below an institutional level where they want to reverse price from. So look, do you see this? We're chopping up, we're chopping up, we're chopping up. This is seen as a quote unquote bear flag, which is fine. It's exactly the same logic if you want to use retail logic. This is a bear flag. But the reason why this sells off so aggressively after is because we're engineering, this is the bullish case, we're engineering, right, liquidity above or below the marketplace, and we're inducing individuals to get involved in the direction that opposes where the price wants to go. So look, we come up to here, we don't hit this fair value gap yet, and then we sell off. So this here induces some form of price action. Then we push up into this fair value gap, and we start to sell off roughly a little bit, right? This induces more short sellers and more buyers. We keep doing this until eventually we make the final push up into what, right? Into OTE of the range, where smart money wants to accumulate, right? Or smart money wants to finally reverse price. So for them, they're happy with reversing price here. They've now have all of this low resistance liquidity in the form of inducement that they're going to be able to reverse against. And as you can see, all of this in here is what is ICT refers to as time distortion. So I want you guys to take a look at the time at which this is happening. 8:35 to 9:35, okay? What happens at 9:30 in the chat? Someone tell me. What's 9:30? Can someone say equities open? 9:30 is equities open, right, guys? Okay. The market has no business moving lower, right, before time is met. Time is so important to these setups as well. So you'll notice this idea of inducement will usually occur in a dead zone, is what I call it, an area where you don't want to be trading. So for me, I wouldn't trade from after high impact news drops until equities open. And then notice we use the volatility injection at equities open after this period of time distortion to make the final move in the sell-off. If you see inducement and you can pair it with a time that'd be unlikely to have a real movement, what's taught as time distortion, you have the makings of a very, very high confluence model. So you can say this is cherry picked. Also, again, here's the schematic. I'll send a picture of this in the chat. Generally, we want to induce into a PD array in the 2 to 2.5 deviation range before we're going to reverse. So as you can see here, right, the lows, we have 2 to 2.5. I taught you guys this in the last lecture. It's a key reversal area. And if you look at like the hourly, for example, here, you'll see that the 2.5, right, the bodies hold because the algorithm isn't referring to a chart that we see. There's no time and price. They don't see a time and price chart. What the algorithm refers to is time and price coded as levels, right, as specific points of data, not as a chart with candles. So this 2.5 to 2 is a very strong reversal signal in the algorithm's code. And as you can see today, almost perfectly, the bodies not only respect this level of liquidity closing back in it, but also respect this reversal range, right? Okay, so that is inducement. Does anyone have any questions about what I just said? Interesting. Yeah. And while you guys are writing out your questions, if you have any, I'm going to show you another example to really make this concrete that we can observe in price action. So let's go back to last night. Yep. Yeah. Yeah. Mm-hmm. Mm-hmm. Yeah, of course. So the way I think about shallow raids is usually shallow raids that are opposing the direction of the draw on liquidity. So again, this is all about narrative, are going to be used again and retargeted as turtle soups. So for example, if we had last night come up here and taken this high on this candle, right? I would say that this shallow raid would be retargeted the next day before we sold off the market. Whereas shallow raids in the direction of the draw on liquidity are a signal of smart money reversal. I know it's not a perfect rule, and that answer will often leave some ambiguous cases. But if you backtest where we get shallow raids, here, I have a great example for you. Do you see how we return back into this inefficiency on the daily time frame before we sell off in August? Right here? Yeah. So this area of the PD array doesn't even balance a discount. So for me, this would be a quote unquote shallow raid or shallow trade in to this fair value gap. Do you notice how the draw on liquidity is still lower, right? But it's retargeted up here. So shallow raids in this case are going to be retargeted entries for turtle soups like this on any time frame where you get another raid on liquidity into a premium or discount level. So I guess the better way of saying that is if you want to look at what is considered a shallow raid and whether it's going to hold, look at the PD array of interest at that level and if it rebalances a discount or a premium. Does that make sense more maybe? So do you see this reversal right here today is in this hourly fair value gap, right? We balance a premium or a discount of this fair value gap, correct? If we had only come in one tick into this fair value gap, that would be considered a shallow raid, and we might get a similar reaction as we did up here, where we don't balance a discount or premium, and then we retarget that in the true direction of the draw on liquidity. Sell off again. Here's an he, yeah. Let's find one on the daily range. Here we go. So this low, you know how we have a candle body closing through this low right here? This low right here is going to be protected because this is a deep raid of this liquidity pool and it trades into a premium level of this inefficiency, which is going to be, as you can see, it's really small, but it's there, this daily fair value gap, right? This is very unlikely to be retargeted. As you can see, this low holds. And then this is a failure swing, right? And then we push up. That, yeah, without seeing these? Yes, that's why it's important to always trade in the direction of ERL to IRL, right? You were at my last lecture, right? So, okay. So after, if you want to watch it this weekend or something, I talk about exactly how I trade the daily time frame down. So here I'd get an hourly confirmation that we're going higher. And once I have that hourly confirmation, I'm confident that this is going to hold. Market structure shift, yeah. It's called by program activation in a market maker model, right? So this would be the sell side of the curve, and then this is now going to be the buy side of the curve. And the reason why we're retargeting this high is because it was a shallow raid. So on the buy side of the curve, this is going to be the target, this shallow raid right here, because shallow raids are always retargeted in opposing the direction of liquidity. Whereas here, if you look at this fractal of price right here, right, we come back up and we sweep out this swing high, correct? This is a swing high on the daily chart right here. Agreed? So then we move from this swing high back into this. Right here. Oh, this one right here. Here. Yeah, but this is, again, this raid, right, that comes in here does not get revisited until we complete the market maker model on the daily chart, which is this high. Now we have a smart money reversal, and now we're targeting sell side liquidity. This is how the market books, right? The market books in terms of this is the original consolidation all the way down here, correct? Accumulation. If you again, you have to watch my last lecture, but this is the original consolidation. Accumulation one, accumulation two, sell program activation, accumulation one, accumulation two, deliver into sell side. So the market books in these models, the buy side and sell side of the curves. But if you want to know what will be retargeted and what won't be, right, you can look at how deep raids are before you get displacement higher. So for example, here's a great example. Tell me what you see right here. Actually, this is exactly what I just taught you guys. What is this right here? What is this price action right here? Now that you know it, what are we doing in this price action right here? What concept? What concept is this? Someone else say it. Everyone say it in the chat. What is? I just taught this. What is this? A return to this fair value gap is what? Again, we're gonna look at this again. I'll show it to you guys. Okay. Look at this schematic right here. Right here. And now look at this chart. Do you see a similarity between this schematic right here and this chart? What is this right here? Inducement, nice. It's inducement, guys. This is how I want you to think about the market. So what you can do, this is a daily time frame because as I teach you, price is fractal. Price only cares about the price will reflect these same patterns on all time frames, whether you're trading on a 30-second or 1-day chart. Above this high, right here, is what? What's above this high, guys? Yes. Nice, thank you. You know what? You're gonna have to do all the talking. That's fine. It'll be really beneficial when people rewatch this recording because we'll have some engagement. So buy side liquidity. In here, we are having what? What is happening in above these highs? Offset accumulation, right? This is order pairing. The first thing I talked about, right? So right now, smart money is absorbing the buy stops and they're selling short. Because for you to get filled on your buy stop, that means you must buy to close and someone has to sell to open. They are selling to open. Then, again, remember how I said time distortion, right? This is an improbable time to reverse. Look at this right here on the daily chart. Now, I know we have some traders potentially who use more seasonal tendency than I do, but Can someone tell me? Can someone look at the month of April after this and tell me if April is a likely expansion month? Let's look back at the last year. Yeah, Gomez, you're here. Gomez, does April? What's April seasonality? Uh, uh, can you look up if April for indexes is a month of consolidation generally or expansion? I just don't want to switch charts, or else I'd go to a higher time frame and do it. Maybe I can do it. Okay, so you guys see April here as a doji? Let's look at the previous April. Oh, this April expanded. This April expanded. Okay. Okay, they expand. So I don't have that argument going for me. I wanted to see if on I wanted yeah, I wanted to see if there was some sort of time distortion happening. Okay. Okay. So there's no concept of time distortion then. I don't trade like the higher time frames like this, like the monthly chart really. But anyways, there's no time distortion happening here like we noticed this morning, which was very clear time distortion between 8:30 and 9:30. 9:30 is a likely expansion time. But again, this concept in here is inducement. So what we are doing in this piece of price action right here is we are returning back into the fair value gap and we are creating low resistance liquidity, these failure swings, right? There's a couple of liquidity raids in here because we're on the daily time frame, but generally speaking, this is all low resistance liquidity that rests above this high. And we're just inducing the other side of the market. Eventually, come back to your point, Jage, what happens here? Right at this point right here. Would you consider that a deep or a shallow raid? Right here. Yep, a shallow raid. The point of interest, like I said, if you look at the schematic, higher time frame PD array is here. We are creating low resistance liquidity above it. Do you notice, guys, how we here's the real takeaway. That's really important. Do you notice how we're not trading into it? Has anyone seen that? Like, look at this. We're not trading into the PD array. What do you think is happening on each of these days? Would you think this is high or low probability conditions each day? I mean, look at the chart. Do you want to? Is this a range you guys want to trade? Yes or no? Put in the chat. Would you think that this is better to trade, or is this better to trade? What's better to trade, guys? This range in here or this range here? Expansion, obviously, right? But the reason why that range is so explosive is because we've induced. The market requires liquidity to move, meaning above each of these highs is what? Buy stops, right? Meaning when the market makers eventually reverse against all of these, right? Positions, they get to liquidate all of these stop losses, so weak shorts in the market after trading into the higher time frame PD array, then push up using all of that generated liquidity, right? Of people buying to close. Because they're buying to close, price is being driven up higher. Think about what I just said. If smart money is accumulating down here and they push price up, tell me, guys, what happens as soon as price starts to push above here? All of these stops begin to get liquidated, right? And that means a ton of buy orders are flooding the market, correct? Because we have buy stops. Look at what happens when these buy orders flood the market. Smart money soaks them, and then price rips up higher because all of these buy orders are now being activated in the market. So in this range right here is just inducement. And that's why we get weeks like this, guys. That's why we get months like this when we don't return in to a premium or discount PD array. Look at this. Look at the dealing range. Do you notice how this fair value gap, is it in discount or premium, guys? In the chat, is this fair value gap on the daily in discount or premium? Premium. Does smart money want to reverse prices from a premium or discount PD array? Yep, it's in premium. Jage, does smart money prefer to reverse price from a premium level or a discount level? Oh, cool. Cool. Hence why you can see that all of this in here is just time distortion, guys. All of this price action in here is exactly the same as this schematic on the higher time. This schematic I'm showing you is for the 5-minute chart, like it happened today. Look at this. Now look at it on the daily. We have exactly the same premise happening right here. We have time distortion because we have yet to trade in to our discount PD array. So eventually, once we trade into the discount PD array, notice again, Jade, like the Rio concept we were talking about was here, shallow raid, it's retargeted, right? Because on a lower time frame, what do you think exists once we push up out of this shallow raid? What exists here? In this price action higher. Between this low. Yeah. What does that look like? Are these failure swings? Yeah, right? Low, higher low, higher low, higher low, right? On the daily time frame, these are all all higher lows, correct? So if you zoom down to, yeah, yes, completely. Low resistance liquidity, as defined by ICT, is failure swings. Okay, so on the daily you can't see it as well, but on a lower time frame, what I was trying to refer to you is this shallow raid right here by 1 or 2 ticks into this daily fair value gap, right? Do you see on the hourly how we are creating this, and we're creating this? Like maybe that's better, or even this. Do you see how these are, or even this? Do you see how all of this liquidity is also low resistance on the lower time frame down? Does that make sense or no? After we reverse by 1 tick out of this fair value gap on the daily, do you notice how we put in these failure swings? Yes. Let's go back to the daily time frame because this is all fractal. So in between generating this low resistance liquidity on the daily, which is exactly what smart money wants to do in this time distortion. Time distortion, guys, is the period by which price is not trading in to the PD array that it wants to reverse from. That's what ICT teaches as time distortion. And that usually happens in what he calls dead zones. Like, for example, this morning we had a quote unquote dead zone right here from 8:30 to 9:30 waiting for the liquidity injection at 9:30. But here you can see we are not trading into this PD array. And when we do, we trade in 1 tick, we push up, and then eventually we reverse back against it after we stop out these highs, right? Again, everything is fractal in terms of price. So we run out this high right here, then we run out the low, and then all of this liquidity to the upside becomes low resistance. That's the difference between a shallow raid and a deep raid. This slow is now a deep raid of that liquidity, taking out this, which was also just inducement on this leg up. So now it's getting confusing. What I'm trying to tell you is that a shallow raid will usually result in more inducement if we're looking at just the concept of inducement. Jage, tell me if that's confusing. A shallow raid will result in lower time frame inducement. Yeah, absolutely. Yeah, and I'm using the daily time frame. But if this, but say this was the treat this like the 1 minute, Jage. Would you enter right on this tap of the fair value gap here? If this was the 1 minute, right? Do you notice how you'd get stopped out against? You have to recognize that what I'm telling you is to treat the daily chart like the 1 minute, and you'll unlock the potential for daily bias, right? So when you say, for example, you don't see these candles to the right, okay? You're just here on the 1 minute chart. Using the concept I just taught you about shallow raids leading to more inducement and this concept of inducement, do you think that we're going to displace from here? Yes or no? Exactly. So what you can do is be prepared for this raid lower and then for explosive price action higher. Notice, if this was the 1 minute chart, right, you get exactly what I'm talking about in the schematic. Engineered liquidity, higher time frame PDRA is just being teased. We're teasing it here, we're teasing it here, we're teasing it here, and then we finally trade into it, right? Teasing it, teasing it, teasing it. This even is considered a tease because it doesn't actually engage a discount level of it. Then finally, right? 10 days later, if this was a 1 minute chart, so 10 minutes later, we trade into it and we get our model 2022, right? Liquidity sweep, fair value gap, enter here, boom, right? You guys have all seen this on the 1 minute before. How many times, right? But what you haven't probably noticed is this signature, which is what is going to define high probability conditions. So when I say high probability trades, when I'm very confident in my trades, I add this confluence of low resistance liquidity. And this low resistance liquidity for me is inducement. If I see it trading in to a point of interest, right? Like this, if I see this specific point of interest, which hasn't been hit and has just been engineered liquidity above it, like this, I know this is going to be a good move. So for me, this is a 5-star setup. And the minute I started incorporating this concept, which albeit is more complex than some other concepts, I noticed I was able to hold my runners and I was able to understand where price was going to expand aggressively. And then, of course, you can use concepts like this, right? You can take a projection from here and you can target levels like the 2.5. So if you're swing trading, you can target these levels and be confident in that because we've had so much accumulation in this area. Inducement is accumulation, but it's accumulation opposing the direction of the true price draw. So all of these shorts that are being accumulated at these failure swings are going to be ran against and price is going to explode higher. And as you notice, it is the exact same thing on the 5 minute. We're accumulating longs. We're accumulating longs in the retail mindset, right? And then price eventually hits our higher time frame PD array, which is this order block right here. And like I said to you guys earlier, why this order block and why not this fair value gap? It's simple. Price doesn't want to reverse from a discount PD array. It wants to reverse from a premium PD array. So notice how the majority of this fair value gap, 2/3 of this fair value gap, is in a discount level. Price doesn't want to reverse from a discount level, so smart money will engineer liquidity, hit a higher time frame PD array. Let me go this higher time frame PD array in discount, right, for the bullish case, and then it will reverse, or in premium for the bearish case, and then we reverse. So that's the idea of inducement. I'll show you guys one more example of how I use this on another trade, and then any more questions, then we'll do the next concept. So right here, so April is an expansion month. Okay, so so I guess we do get our move at the end of April. On the 27th of April, we get a daily range move, one candle that is essentially the entire range of the month before it. Do you guys see that? So all of April expansion essentially happens in 2 days. You see that, Gomez? Because yes, let's. But oh, Okay, perfect. So I want you now. It's a great point. Look at this. We studied this. This makes sense to us. Everyone understands this concept right here. This is clear. How we're inducing into our higher time frame PD array in discount, and then we're exploding through it because all of this becomes money, right? All of this becomes low resistance liquidity, which price wants to aggressively spool through and displace through. That makes sense. Compare this right here. We just saw it. What do you guys see here? What's happening here? Is this the exact same thing we just saw? Yes or no? In the chat, yes or no? Exactly, guys. Think of this like the 1 minute chart. Forget about the fact this is daily and you're telling yourself, I'd be day trading this. If this is the 1 minute chart, look at this. Compare this to this, right? What are we doing? There's a higher time frame PD array of interest right here, okay? Look at what price does here. Do you see this 3 days? How it's accumulating above the PD array? So, for example, on this day right here, how many traders might be bullish for the next day? Again, Jay, do you see the shallow raid, 1 tick? Are you seeing the signature start to repeat? Okay. Uh, Guys, tell me in chat. You don't see the candles to the right. Is this a bullish signature for you? Right? We're trading into this PD array by 1 tick and we're getting a huge... If you didn't know what the concept I just taught you, would you think this is bullish for the next day? Yes or no in the chat? Yes, of course. I mean, if anyone says no, you're crazy, right? This is bullish. This looks bullish, right? If I only showed you this piece of price action and I didn't show you this candle next, you would think this is bullish. And most of retail would too, right? So what is happening, guys, right? Now, here, I draw it for you again. Price from here pushes up, creates a lower time frame, low resistance liquidity, lower time frame. Look at this failure swing. This on the hourly looks like many failure swings throughout the day that are going higher and higher, okay? That's what it looks like. But what we know is that we're going to target this discount PD array and look, accumulation above it, okay? This is the 1 minute chart. This is not the daily chart. Accumulating above the PD array. Accumulating above the PD array. We're teasing it. We're teasing it. We're teasing it. And then we trade into it and we stop out this side of the market as well. The weak longs and then the shorts get absolutely ran. Guys, this is power of three. So what ICT teaches you as accumulation, manipulation, distribution, I'm giving you a signature in terms of inducement, and I'm teaching you to look for fair value gaps. So when people say AMD or power of three, what you should look for is low resistance liquidity runs or signatures trading in to discount or premium fair value gaps. How much simpler does that to make the concept of AMD? This is on every time frame. Eventually, notice we take in all of these sell stops and we reverse. But we don't reverse from here. We don't reverse from this point here. We don't reverse from this point here. We don't reverse from this point here, right? We're just generating liquidity above the market price and we're inducing longs. We're inducing them and then we're going to stop them out and then boom, we're going to rally price. So this is a two-way fuck, right? You guys can see that. This is why some people would call this here a Judas swing, which essentially takes out both sides of the market. Come down, take out the stop losses for longs, and then boom, rip up, take out the stop losses for shorts. But it's this signature in here that you're looking for, and this schematic, I promise you, will repeat itself again and again and again, and you'll get explosive moves out of this. Again, what does this look like after we trade into here? A 2022 model, right? So, push up, take out this short-term high, market structure shift, fair value gap, right? Right here. And enter in the fair value gap. You have an order block protecting you. Market spools aggressively higher. Same exact thing happens right here, guys, right? Here's the inefficiency. Jade, I'm going to throw it back to you one more time. Is this a deep or shallow raid? right here. I've given you 4 examples now, so I'm hoping you can see it now. Is this a deep or shallow rate of this fair value gap on the daily? What happens? We run back against it into what? Into discount or premium, Jage? Into OTE, then price reverses. What is guys? What more importantly, what is happening here? What do you see? Low resistance liquidity, right? Look at this. This is low resistance liquidity right here being generated. So now, look at this image and look at this image, right? We're teasing it. We're teasing it. We're teasing it. We explode. We're teasing it. We're teasing it. We hit it. We come back in, and then we explode downwards. All you have to do is wait for confirmation on the lower time frame. If this was the 1 minute, you're not entering on this candle. You're not entering on this candle. You're waiting for this entry right here. And once you notice, we get the model 2022 on the daily again. Liquidity sweep, break a structure, fair value gap, boom, we explode 1,000 points downwards. But the signature, right, that makes you know we're going to be so aggressively spooling is this right here. Boom. Failure swings, inducement is a return back in to a fair value gap. Inducement is a return back in to a fair value gap. It creates low resistance liquidity. If you have those 2 conditions met, so for your notes, inducement is a return back into a premium or discount fair value gap. 1. If you create LRL above/below the fair value gap of interest, this is a plus inducement. There you go. These are your rules. This is the game plan. When you see in a signature of, okay, a fair value gap is being teased, it's being teased, it's being teased, finally gets ran. Now you know that this is going to be an explosive move to the downside. You can get in on this action. Look at this. The new week opens up, gaps down, a massive, massive sell-off on Wednesday, which is a likely expansion day of the week. That was my previous lecture on intra-week profiles. And there we go. We get that move down for 300 points. We get the return back into the 2022 model. And then boom, just a massive sell-off because we have generated this liquidity. Again, buy and sell side of the curve, right? Buy side of the curve, sell side of the curve, buy side of the curve, sell side of the curve. And we're looking for these low resistance signatures. Like, for example, this right here is a low resistance signature, equal lows, right? This is going to be ran through aggressively. Hence why, Jage, question again, my favorite man for this question. Is this a shallow raid or a deep raid right here of these lows and this fair value gap? What do you think is going to happen? What are we doing? What do we do right here? Okay, we already did induce. Do you guys see this? The reason why I saved this for the end on the daily chart is because I wanted you guys to see that this right here, this week, is just this. Tell me from 5 examples now that you can't see it, right? Where's the point of interest? This fair value gap, right? That's the point of interest. Okay, so we tease it here. We don't return back into it here. So look, we don't come into the fair value gap here. We don't come in here. We don't come in here. We don't come in here. On all of these days, we don't come in. Okay? So all of these highs, this high here specifically, is extremely high liquidity pool because there's a failure swing for the next 3 days consecutively, right? And then this actually, the 4th day, doesn't close above these highs. So we have 4 days of failure swings from that original high. So all of this in here is low resistance liquidity on a lower time frame. You'll see it on the hourly, guys. I can show it to you right now if you don't believe me. It's low resistance liquidity. Look at it. Let me get my hourly chart up. Look at this. What do you see right here? From this side down, right? All the way here. Low resistance here. Low resistance here. Low resistance in here. Then we have all of this price action. Low resistance in here. All this low resistance liquidity. So eventually, we come back. We run against it. Back to the daily chart. We run against it. We take out all these highs. So we take it out on Friday, September 29th. Where's that? Right here. Okay. Sorry, I was looking at the wrong part of the chart, guys. That probably didn't make sense. Here. Do you guys see it? Do you guys see it here? I was like, I'm definitely not looking at the prior chart. Do you guys see the low resistance here? Yes, no? I'm recording it, Rico, don't worry. Yep, you see it? Okay, this is a market maker model. Watch my last lecture, right? Buy, sell side of the curve. I'll do it for you right now, combining lectures, right? Original consolidation, right here. Right up here, actually, is better. A1, accumulation 1, accumulation 2, smart money reversal. Accumulation 1, accumulation 2, distribution, right? And now we're on the sell side of the curve again. Look, original consolidation down here. Accumulation 1, right? Come back in. Eventually we reverse, we break structure, and we target it. This was messy. This I consider time distortion. This really here is time distortion because it's NFP week, so it's not clean. But as you can see, this market maker model right here was the cleanest market maker model I think I've had all year in terms of how I traded it. Last week was my biggest week ever because I used the exact same concept, guys, I just taught you. Like I used literally seeing this. Low resistance liquidity. We're not trading into our daily fair value gap. So then, where'd it go? I wait, let me. Right? Look at this. Do you see how we come up and we don't trade into it? We don't trade into it. We don't trade into it. We're creating all of these failure swings and boom, it gets ran against. This move here was so explosive on Thursday. I remember because in the span of 2 days, we retraced the entire weekly range before it because all of this is inducement. Here's the PD array of interest. And on the hourly, it's less clear, but on the daily, it's clear as day, right? You can see how we don't trade into it, and it looks almost identical to this right here. We're engineering liquidity above or below the higher time frame PD array. Boom. And then we just run against it aggressively. We have a buy program activation down here and a perfect buy and sell side of the curve. In fact, they're almost symmetrical. So in a case like this is literally a perfect distribution from buy to sell side. Right? Exactly the target you want. The target is literally going to be this high because that is the high that put in that daily fair value gap, and everything else was failure to come back into it. Everything else. So on the week, as you can see now, we have an inducement profile, right? Trade into it, and now we're moving lower. And we should, in my mind, retarget this low. There's nothing in my mind that says this low is not being retargeted. We have a redistributed, rebalanced PD array here. Look at the bodies. Here. Oops. Again, if you don't know what this is, go to my last lecture. The bodies are telling us a very, very solid story here about where price wants to go. I could care less about these wicks. I'm looking at these bodies, this redistributed, rebalanced PD array, right? This is holding price down. And the obvious draw now is because we had the complete inducement profile, identical here, and we should sell off to here because this now, all of this low resistance liquidity, right, has been ran against. And it could look something like this because we have more low resistance liquidity up here. This is going to be a target later, but I think we'll come down and then we'll come up. So that is the concept of low resistance liquidity and inducement. Remember the two rules. Inducement is a failure to trade in to our higher time frame PD array in discount or premium, which engineers low resistance liquidity above. Okay? So we're chopping above a PD array, generating these low resistance liquidity signatures. Just to reinforce that, I'll do one more example and show you how I traded it last night in the London session. So again, any time frame works. So today I traded this exact signature on the hourly here, but I traded on the 5 minute yesterday. Okay. Does everyone see this 15-minute fair value gap in here? Let me just pull that. Okay. Everyone see this 15-minute fair value gap? Yes, no? Where the recording is posted? I'm going to post this to my channel. Don't worry. Okay, 15-minute fair value gap. I want you now to keep this image here in your head. Go down to the 5. What do you see here? Compare this price action to this right here. This is all fractal. So my higher time frame PD array, right, for my 5-minute inducement model, I'll use the 15 here. I'll also use the 30 maybe. Yeah, the 30 is good, but it's already been traded into here. But the 15 is a very, very clear level that you can see we are not trading into. We're chopping around. But if you go down a time frame, we're not just chopping around in it. We're creating failure swings. Okay. So now I have a perfect setup. Also, just out of interest, if you guys like deviation projections, I really do. I've gotten into them quite a bit recently. I like to use, let's see what looks like on the 1. Yeah, this is nice here too. Yeah, this is nice here too. I'm going to look for a deviation projection that lines up with my reversal level, my likely reversal level. Again, this is in my last lecture if this is kind of just like alien to you and don't know what I'm talking about. So on the 5-minute, it kind of looks like this Judas right here. Or in fact, a better deviation I would probably use is this breaker block right here. So I would use this high to this low. Again, I teach deviations in some of my other lectures, and it's a concept in and of itself. But essentially, all you have to know is that there's a likely chance that the manipulation above the range will bring us back into a level within the 2 to 3 range. That's what you got to know. You can try and play with deviations and find a range. Again, you don't need any of this. This is just bonus. You can also use quarterly theory here, right? Like PMA was talking to me earlier about, like I marked out my true micro session open. Yeah, I have my TMSO right here. It doesn't matter, guys. All this shit does not matter because I'm teaching you the concepts which are fundamental. The rest of this is just extra like fluff. It's just nice. It just makes your chart look like nice. Whatever. You don't need it. You don't need this, and you definitely don't need this. But what you do need to see is this. The 15-minute fair value gap has not been traded into. It has not been. What we're doing is we're fucking around. we're not trading into it here. We're not trading into it here. Oh, and then we're pushing up. Jay, do you remember what I said about the false push-up? So say, for example, this tapped in 1 tick. Do you see what I mean by the false push-up creates another set of inducement on the other side? Look at the 1 minute now. Do you see this? Then we have the two-way fuck. Incoming two-way fuck, guys. Ready? Boom, boom. Okay, so now I've taught you what everyone tries to teach you as AMD. And I've given you a mechanical way to say accumulation and draw your nice little boxes like Casper does or whoever the fuck on Twitter does, T-Trades. But now you know why it's happening and where it's happening. Because just saying, accumulation, manipulation, distribution, how do you know where to look for it? How do you know when to look for it? And why? And how do you know why you're looking for it? This answers all of them. When are you looking for it? You're looking for it near, right? A PD array that has not been traded into in a higher time frame discount. Why are you looking for it? Because you have a higher time frame context to move into some sort of liquidity draw. Obviously here you guys can see the liquidity draw is this high. Again, watch my last lecture on market maker models, right? It's going to go. There we go. We hit it, right? Buy side of the curve, sell side of the curve. I'm not here to teach you that today. What I am here to teach you is if you combine these concepts, you can say AMD is likely to occur here, and you can anticipate it. You can anticipate it the moment you see the accumulation. You don't need to see the manipulation. You know it's coming. So now you're locked in, right? You're in a high probability time, which is the end of the London kill zone. The London kill zone has sold off. Now you have your late London, which late London between 5 and 7 a.m. is equivalent to New York lunch. Have you guys ever heard what I teach you guys about New York lunch? What happens during New York lunch, guys? Usually, do we retrace or do we continue to expand? Someone write in the chat. Yeah. What? Hmm. Yep. Yep. So if you guys watch this video on YouTube called ICT One Setup for Life, One trade set up for life. He talks about the lunch macro, which is going to be the retracement run on stops from the AM session. So in lunch, backtest this in your own time. If the draw hasn't been met in the AM session, the lunchtime session will reverse on protected highs. That's the macro that happens in lunch. And then it will continue in the PM session. It kind of looks like this. I'm going to do a lesson on this one day as well, which is going to be just market profiling guides. But essentially it looks like this. You sell off in the morning. Then during lunch, you have OTE or protected high. Boom. And then you have 130 Judas and then sell off again. It's kind of like this. This is a very, very classic New York kind of profile where you've sold off until noon. Then noon retraces to the optimal trade entry of the kind of entire range like this. Kind of looks something like this. And you can backtest this. Don't take my word. Please backtest it. We trade back into a discount level or a premium level. And then, yeah, I'm more than positive this happens quite frequently, especially when you're looking at profiling guides and the draw on liquidity. Of course, you have to pair things with narrative. I'm never going to say this happens without narrative, but once you get good at determining where the price is likely to expand to, you'll see this. So for me, what I taught you here is that you're looking for 3 conditions. You're looking for low resistance liquidity to be generated above a POI, which we're just fucking around in. That's how you can think about it in your head. We're just fucking around. We're not trading into it, but you're seeing this. And this is going to be like, aha, this is the aha moment. You're saying low resistance liquidity. Then you're going to combine time, right? You're going to combine time because you never take a trade without time. Look, you have exactly what I teach you in terms of looking for pairing time with price. You have late London, i.e. London lunch, from 5 till 7. Okay, there you go. You have a time window where this is likely to occur. I'm not looking for this outside of the time, right? Because I'm looking for this time distortion right in here. This bullshit is time distortion. We're waiting, right, for the expansion to occur during the London lunch. And then we're going to expand higher. And look, exactly like we do in New York, look what happens. We run out the highs, and then boom, we trade lower, right? Look, this is exactly the same as New York, right? We're chopping lower, we're chopping lower, we're chopping lower. Then during lunch, we retrace, and we actually retrace a significant amount because this is New York Open, right? For high impact news, 8:30. And then boom, we continue trend. But you don't have to worry about any of this because you're not worried about that. You're just trading this, and you're seeing it now, and you're seeing why it happens, your accumulation, your manipulation, your distribution. The higher time frame PD array is here, and on the lower time frame, as I told Jade earlier, we're generating this LRLR and this LRLR. Eventually, we're going to have our two-way fuck, Judas swing up, and you can enter. And you can target the original consolidation, right? So on the 5 minutes, even more clear. The original consolidation is right here. And if you want to get fancy with it again, take some projections, use some freedom, use whatever you want, right? And you can target something like this. Let's look at the 1 minute, see if there's anything more precise. Yeah, maybe do this. There you go. Target 2. Notice how 2 lines up just with your draw and liquidity. There you go. Okay. So you don't have to use these projections, by the way. I'm just saying that's something you can add if you want. What's nice to do is use these projections to see the manipulation above the range back into this because you're anticipating this now. Now, when you look at the chart, you're going to see this 15-minute fair value gap is my higher time frame PD array. I am interested in seeing what price does near it because inducement models happen all the fucking time on every single time frame, whether it's the daily chart, 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 or the 5 minute chart like it did this morning, right? Where is it? The 5 minute chart like it did this morning right here, right? Same exact thing. PD array is this. We're fucking around, we're fucking around, we're fucking around. Okay, we finally move in with time. Equities open 9:30. If you want to be use quarterly theory, then sure, align it with the true market session open, which is going to be somewhere in here. This is the TMSO. All of your different confluences, whatever, it doesn't matter because you're expecting it. You are expecting to see this run generate low resistance because this 5 minute fair value gap is the PD array of interest, or this order block to be more specific. There you go. That's inducement. Generation of liquidity opposing the direction of the draw. Once you start to see these patterns, you're going to start to realize they repeat all the fucking time. And then it happened last night as well. And yeah, that's that concept. Any questions about inducement? Anything at all? Because that's the full concept then. They're all in my channel somewhere. I should create a lessons recap because they probably have to scroll, but they should be in my channel somewhere. I would recommend just watching the last lesson, which is my Market Maker X model lesson. That is the model I use. It's the model I turn profitable with. And if you pair some of these concepts with that model, like which I have been doing in this lecture, obviously, because that's how I trade, you're going to have really, really nice edges that play out. And you're going to just see patterns, man. You're going to see this stuff repeat time and time again. Like especially like I don't know, I have these schematics when I was first starting to learn printed out on my desk, and I would literally have this printed out, and then I would see something like this, like look at this. I would just look at price and be like, oh my god, look at this, or I'd be like, holy shit, look at this, and just seeing it in price, I'd gain trust, and I'd start to notice this everywhere, and then I'd start to be like, okay, now I'm looking for AMD, and I'd get it, and then more and more reps and more and more reps. And now I don't need the schematic, but I can just naturally point to price and be like, look at this. LRLR, here is the higher time frame PD array. LRLR, here is the higher time frame PD array. And we're just kind of dicking around. And you'll notice it's super effective. And over the weekend, if you have time, backtest this. And don't take my word for it, obviously. Never take my word for anything. Go and see if you can find it for yourself on the chart. Okay, that's that concept. There's one more concept I wanted to do. Oh yeah, PMA just posted my trading plan. This is the 5-minute market maker X model. There's a lot more detail in the lecture, but here are the kind of Cole's notes. The next topic I wanted to teach you guys, if you guys want to drop, that's fine. I enjoy teaching, so I'll stay on and we'll do it quickly, is going to be on protraction profiles. So now you know inducement, which is super cool. Really, really awesome concept. Now I'm going to teach you how to look at the London session and anticipate what New York is going to do. And this is going to make you a very, very powerful trader when you combine this with the daily draw on liquidity and kind of how I've taught that. So what is protraction? There are only two types of protraction, classic and delayed. Can anyone take a guess? I just updated you and your channel for your last. Oh, perfect! You pinned it. That's amazing. Um, I'll pin it after this. Thank you so much, guys. Really appreciate it. Okay, can anyone take a stab at what protraction means? There's no wrong answers here because you've never heard of it before, maybe. Okay, so let's take out some. So to extend. What else? What else do you have? Everyone, give me something. Come on, let's get more engaged. What do you guys think protraction means? Okay, so Jade's just doing everything here. You guys should thank him because he's teaching this lesson just as much as me. It's awesome. I love that. Okay. All right. I won't make you guys play this elementary school game of give me some words and I'll tell you if you're close in the end. Okay. Yeah, that's what protraction means, guys. Just like the English definition. The definition of protraction as it pertains to smart money concepts and the way I trade is a Judas swing. You guys all know what a Judas swing is? Yes, no? Everyone know what a Judas swing is. Don't want to come off, just put it in the chat. Yes. No. Perfect. I'll explain it. All right. A Judas swing is equal to a directional movement in price away from our higher time frame drawn liquidity. Okay? Specifically, right, a Judas swing is a directional movement in price targeting liquidity away from our high time frame drawn liquidity. Does that definition work for everyone? T, what's your full name here? Trade chart game. Make sense? A directional movement in price targeting, let's say, opposing liquidity to make it even more clear. Yep, makes sense. Makes sense. Okay. I'm going to take your guys' lack of response as that makes sense. Okay. So, there are only two types of Judas swings, and a protraction occurs in the London session. So, there is classic protraction and there is delayed protraction. Classic protraction means that from 12 a.m. to 2 a.m., we Judas. Delayed protraction means from 2 a.m. to 4 a.m. plus we Judas. I'm making this as simple as I can. The reason why London often puts in the high or the low of the day is because protraction, by definition, is the accumulation for the daily draw of liquidity in a discount or a premium. I'm going to say it again. Protraction is the accumulation during the London session for the daily draw on liquidity. This is going to be in either a discount or a premium. Okay, so given that definition, does anyone have an idea of what I might use on a daily time frame, right, for discount and premium? What level might I use? Not looking at their charts, just a specific level each day. ICT has taught this as a coded level or price that the algorithm refers to for discount and premium on the day. Someone put it in the chat. Yeah, Jage, fire. London high or low? There's no wrong. Yes! Ah, there we go. I love it. I love it. Boom! I don't know what the hell a God Mop is. Son, that's the true, actually, I'm joking. That's the true week opening, right? I actually use something on Monday at 6 p.m. Simply because I prefer using a weekly profiling guide that doesn't include Sunday. And one day I'll do a lesson on that. But yes, the God Mop or the Sunday opening price at 6 p.m. is also often an institutional level referred to as discount or premium on the week. So now I'm teaching you a discount and premium level that's coded by the algorithm on the day, and that is the midnight opening price. So let's put together everything I've just said. I've kind of walked through with you. There are only two types of what we call quote unquote protraction: classic protraction and delayed protraction. We understand to be protraction to be a Judas swing, right? Targeting opposing liquidity away from our higher time frame, our daily drawn liquidity. Awesome, these are all the concepts. Now we're going to use the specific level of the midnight opening price, right, as the confluence for discount and premium, and as the confluence for our Judas swing and the direction we're opposing, the direction we're moving away from the opposing draw on liquidity. So we're combining all these concepts, and what we're saying essentially, in very, very simple terms, is if from 12 a.m. to 2 a.m., I'll write it again. If we are bullish on the daily, and from 12 a.m. to 2 a.m., we trade below the midnight opening price. What is this, guys? Classic or delayed protraction? You guys tell me. If we are bullish on the daily and from 12 a.m. to 2 a.m. we trade below the midnight opening price, meaning we are in a directional movement opposing the higher time frame draw, away from it during 12 to 2. Is that classic or delayed based on what I just said in this text box? Classic, nice. Everyone understand that? Is there any questions about that? Because none of this will make sense unless this part makes sense. Jage, fire, you understand? Okay, no worries. There are two types of protraction. A protraction is going to be a move opposing the direction of our daily draw, right? And we're going to use the midnight opening price as the level to determine if that move is happening. So essentially, if from 12 a.m. to 2 a.m. we trade below the midnight opening price and we are bullish, that is a classic protraction. Make sense, Jage? Got it. Cool. All right. So you know what's happening next. If we are bullish on the I'm not going to repeat that. I'm just going to go from 12 a.m. to from 2 a.m. rather to 4 a.m. plus. Is this classic or delayed protraction? If we don't do it from 12 to 2 a.m., but we do it from 2 to 4 a.m. Delayed protraction. There are only two types of protraction. Here you go. Take a screenshot, write it in your journal. This is what we're going to use for daily, intraday profiling guides. So I will teach you in the future intra-week profiling guides, which are so important. But this is going to be the nitty-gritty bread and butter of the daily intraday movement. Okay. I'm also going to tell you one thing that ICT doesn't teach, which is really important. If we do not protract in the London session, right? Meaning, for example, if we are bullish and we continue to pump from 12 a.m. to 8 a.m. with no accumulation below the midnight opening price, what do we expect? Sorry, I'm writing paragraphs now on here. This is something I want you to think about, and I actually want to see some answers because this is gonna tell me if you're paying attention, which you should. Which I'm not trying to like quiz you, but it's really important. What do we expect in New York Open? Someone come off mute and tell me. Maybe Jage, you've been active. Tell me what you think if we do not protract in the London session. So we don't trade below the midnight opening price and we're bullish. What do we think New York's going to do? Ah, nice. New York Open will reverse trend. Okay? Okay. Here's the distinction that is so critical that people miss. And this is going to tell you whether, oh my God, why didn't we have a Judas swing at 9:30? The question I want you to ask yourself going into each New York session is this. Here, right. You will be profitable if you can answer this one question. We're all New York traders here. I also trade London, but we're all New York traders. Is New York Open, right? We trade the New York Open like 8 a.m. till noon, essentially. PM session is its own thing, and I will teach you one day how to become a monster in PM session using intraday profiling, but that's not the context of today's lesson. If you guys have ever read my stuff in Nap's channel, PM session is also an equation of itself. It usually involves some retracement. It usually involves some sort of similar Judas swing, and then it usually delivers if it hadn't delivered already. But let's talk about just the open. Is New York Open likely to continue or reverse trend of London? Now, what's the difference between trend and direction? Can someone tell me? So, trend is going to be equal to our higher time frame draw, and direction is going to be equal to our lower time frame movement. Okay? You'll notice often New York, if we're bullish, will have a deep retracement in the morning, in the Judas swing, but it will continue in the trend of London. Don't believe me? Let's look. Couldn't have cherry picked a better day to do this lecture. Okay. Where's my mop? Make this nice and big. Here's a question. Are we bullish or bearish on the daily today, Thursday? And again, this requires you to know the concepts of my previous lecture and how I determine if I'm bullish or bearish on the daily, obviously, because remember, the first question is, right, a directional movement away from our higher time frame draw on liquidity. So I'm going to tell you, without having to explain my last lecture how I do that I was bearish on the daily. And I'll quickly explain. I was bearish on the daily for one reason and one reason alone, and that is because I trade market maker models, and I use the daily, ERL, and IRL. So because the daily traded in to our fair value gap, our daily sell side imbalance, buy side inefficiency, and we rejected it with displacement, I am now targeting for the week, my profile for the week, my objective is this 586 level. I even have it on my chart as drawn liquidity, daily ERL. So for me, I'm only looking for shorts, at least to play for long continuation of trend. You can scalp longs, whatever. I'm not going to tell you how to trade, but my daily bias is short. Okay, so now that you know what my daily bias is, assume that you were trading alongside my daily bias. Here's the question for you guys. Do we accumulate, let's go down time frame to the 50-minute. Do we accumulate above the midnight opening price in London at all? Put it in the chat. Yes or no? Here it is. Yes, we accumulate above the midnight opening price in London? Really? Uh, for maybe 5 minutes. For a period of 12 a.m. to 2 a.m. or 2 a.m. to 4 a.m., right? Like this says, do we accumulate above the midnight opening price during this section of time? Let me use something like this to show you. Do we accumulate above the midnight opening price in this section of time, guys? Yeah, I don't count this 5-minute candle or this. I do not count this 4 minutes or 5 minutes of price action to be accumulation above. No. That's why I give you guys the hourly time frames to consider. From 12 a.m. to 2 a.m. or 2 a.m. to 4 a.m., do we trade above the midnight opening price? Remember, my daily bias is bearish. So protraction means we have to trade above the New York opening price. If you guys understand this, the answer should be no. A definitive no. Here's where this gets so powerful, guys. And for people who actually pay attention to these lectures, like, kudos to you, because I know it's easy to zone out, but I'm literally giving you how I daily profile and how I trade alongside. Like, this is exactly what I do every single day to try and make profitable trades. So if you're actually paying attention, like, really good for you. I like to teach, and I'll do it whether you guys are paying attention or not, but this is some really good stuff. That's not taught really by ICT well, in my opinion. I mean, I didn't understand it for a long time. Because we do not protract or accumulate above the midnight opening price, what do we expect, right, in the New York Open, which is roughly, I guess, once London ends, so anytime from like 7 a.m. onwards. Reversal of trend. Guys, I'm going to say this and take it in your notes if you're listening. London will put in the high or the low of the day if it protracts. If London does not put in the high or the low of the day, it is because it didn't protract. There you go. That's it. Don't believe me, just backtest. Don't take my word. If London protracts, London will put in the high or low of the day. If London doesn't protract, New York in the opening will reverse on trend, stop out the London high, and then continue. This is why I'm saying direction is a lower time frame movement, trend is a higher time frame draw. As you can see, we reverse trend all the way from late London, early New York, 7 a.m., all the way up on the 15-minute till we take out that high. So this high is not protected. What I'm teaching you is whether or not you can expect the high or the low of the day to come from London or not. On a day like today, we don't expect London's high to hold. And the reason we don't expect London's high to hold is because London did not accumulate in a daily discount. So the institutional price delivery algorithm is referring to the midnight opening price as a daily discount or premium level. And because premium, right, if we're bearish, was not generated, look, I'm going to draw you a dealing range, right? Because we did not accumulate in any form of the midnight opening price lower, anything above the midnight opening price, right? Let's do it like this. Anything above the midnight opening price is going to be our premium. Anything below is going to be our discount. Because the day leading in to New York, right, did not accumulate in premium, we can expect a reverse in trend into the open. That's the Judas swing, and today it happens before high impact news. On a non-high impact news day, it might happen at 9:30, which it will. That's the time it's coded to happen as equities open. But here we do it before. Why do we do it at 7:30? Because news is going to want to send us lower. So we get that out of the way before news starts. But look, London's high is not protected, and that's because the algorithm didn't get to accumulate in what it considers to be discount. Boom, you just learned something incredibly powerful. Then you can expect a New York Open rip. In this case, it happens before New York Open, but this is just time distortion, guys. So the fact that this is not happening from 9:30 to 10:30, essentially, right? And it's instead happening from 6:30 to 8 is because time distortion and because high impact news at 8:30, and the algo, right, is going to deliver the daily draw on high impact news. The daily draw is these failure swings. Remember, look at my last lecture. This is the market maker model on the hourly. Look. Original consolidation, accumulation 1, accumulation 2, smart money reversal, accumulation, no accumulation, just smart, like just dump on news. But here's the draw right here. And it's even more clear on the 5-minute. You can see it very clearly, right? Buy side of the curve, sell side of the curve. So what I'm teaching you is New York going to take out London highs or not? Let's do another example. It's the best way to actually prove this to yourself. So is New York Open likely to continue, right? London trend? Meaning, is New York Open likely to not stop out London highs? Let me just write that. Maybe that's easier. if New York Open is expected to continue trend, London will be high of day or low of day, right? Only if we trade into a daily level. Remember, the first question is, where's the daily likely to expand? Only if we trade into a daily level before New York opens will we reverse and London will then not be protected. So for example, let me give you an example. If London did this and protracted above, so if London protracted above the midnight opening price today, right, came up here, and then sold off before New York, we'd expect New York to reverse trend. Why? Because our higher time frame draw on liquidity has switched, right? So now the first question we ask is, what's our higher time frame draw? Because the higher time frame draw, which I always have marked out on my chart right here, boom, higher time frame draw. Why? It's an hourly inefficiency, right? We're in a sell model. Look at my last lecture. It'll be very clear to you why I'm bearish on this day. If this draw hasn't been met, I'm looking to see what London did. And if London doesn't protract, I'm expecting this stop hunt. I'm anticipating this high to be ran. And it is. If we had traded down and dumped all of London, like for example, I mean, I couldn't have cherry picked a better day for this lesson. Look at this day, right? On this day, we were bearish until this low. The draw on liquidity is this low. As you can see, we come in, and this sucks because we really come within like, I don't know, 2-3 points. It's super shitty. But essentially, having seen London do this, and look, again, I'll mark out our midnight opening price so we can all see it. London, as I'm bearish for this low, let's go down to the 15-minute. From midnight till about 2 a.m., 1:45, protracts above. So for New York, if we don't hit this low, I'm considering a continuation. Now in this case, the algo is leaving this low for later, so maybe it's referring to this low. Let's just say that was the draw. Unfortunately, I would have loved for it to hit the lower low here, but it doesn't, so it hits this low. Now that London has met the daily objective, right? Just because we protracted here doesn't mean New York is going to come up and leave this high intact and sell off lower because the daily draw has been met in London. So when you show up to your computer groggy-eyed at 8 a.m., you're going to be like, oh, the daily draw was met in London. That's why I tell you, if you're not profitable, don't trade London. London's giving you all the insight you need to crush New York because it's telling you what's going to happen. So now we wake up, oh, the daily draw has been met. Now what do we expect? A reversal or continuation of trend. Well, the daily draw has been met. So now we go back to the first question. Did London retrace or protract away from the daily draw on liquidity, right? So now we are bullish on the daily, not bearish. Well, yeah. What do we have? We had delayed protraction. So now you're seeing that once the draw has been met, there's only two types of protraction. London is a delayed protraction. So what is going to be held as the low of the day? At first, right, when we first monitored this day at open, right, midnight, we said we want to draw into this price. If we don't, we expect New York to. Okay, so London accumulates above and boom, 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 sells off. Now we walk in at 8 a.m. right here and we're like, what's our daily draw? Our daily draw is bullish. So did London accumulate below the midnight opening price? Of course it did. When did it do it? From 2 a.m. to 4 a.m. plus, or actually from 2 a.m. to exactly 2:45 a.m. and then it reversed at the draw. So what are we saying? What type of protraction is this? Delayed protraction. The low of the day is not, we're not coming back down here. You know immediately that this is the low of the day, right? And that what's New York likely to do? Continue trend. And as we do, we continue trend. Look what New York does. New York retraces a short-term discount. Short-term. So if you look at the dealing range, let me do this so it's easier for you guys to see. If you look at this dealing range right here, from this low to this high, Yeah, New York retraces a discount. And then it keeps going higher. It's not coming all the way back down here. It has no reason to, because the algorithm has already accumulated net long in daily discount. This is the MOP. Algorithm refers to the MOP as the daily level of discount. We're not coming down. This is protected. What we will come is into some level on the hourly, or let's go on the hourly even. Yeah. That makes sense. What makes sense? Oh, well, I'm no genius, but this looks like a really good level for New York to come into. This fair value gap. Perfect. Nice. We come in, and boom, massive expansion upwards because the daily draw is now higher because we've met the daily bearish draw and we've reversed trend. If you guys came to my last lecture, you know that this high, when it's broken, is a market structure shift, and that turns this low into what I call a buy program activation. If this is foreign to you, watch my last lecture, and you're going to learn all about market maker models and how I anticipate that. But look at New York. Go down time frame to the 5 minute. It comes into our hourly. Guys, just combining concepts. Someone please tell me, what is this? What is this? Everyone please say it. It will give me a lot of happiness if like more than 2 people say in the chat what they're noticing here. Consolidation, what type of consolidation? What do you notice here and then here before, like here? PMA, you're on the right track. What do you notice here? And then what do you notice here? And then specifically, what is this? LRL inducement. Yes, you guys see how they connect. This idea is worth studying. Look, compare what you see here. Study this, right? Study that. You guys are going to have, where the fuck did my other thing go? I lost something here. Oh no, I lost that schematic I gave you guys. I'm very sad. Okay. Compare this with this. Okay? Look at this. And look at this. Okay? Let me go back here. Manipulation above the range. This is a 5 minute chart. Right? So here are our stops. We're manipulating above the range. We didn't trade in to the hourly gap yet. We came in and we created low resistance liquidity down here, right here. Boom. This is going to be targeted. That area is going to be targeted because it's inducing, right, kind of fucking around, like I said, right near a higher time frame PD array. We can anticipate it. So then what are we looking for? Let me get rid of that dot. We're looking for that to actually be red. And look what happens right here, guys. What is happening again right here? Look at these points. Look at these points. Weak longs are entering the market here. They're entering here, getting stopped out. They're entering here, getting stopped out. They're entering here, getting stopped out, because this might not look to you like an entry model on the 5 minute. You got to remember, there's millions of people trading what looks to be these expansions. Look at that market structure shift, return to fair value. Look at how many of you before this lesson might have thought, and there's no shame in saying that this would have been an optimal entry right here in this fair value gap. I would have just a couple months ago, or maybe 6 months ago, 3 months ago, I would have said, this is an ICT 2022 model right here. But then I realized that if I can notice obvious inducement, because the higher time frame PD array is this hourly fair value gap. It's not this random piece of pricing here. This piece of pricing here means nothing. All of this is just what? Look at this. Let me draw my arc for you. It's all going to click in 1 second. Oh, that's not an arc. Right? These might be lower lows, but all of this here, right, from this original displacement, this hourly fair value gap, everything else in here is just failure swings. This is the low that's going to be targeted because this is the PD array. So all we're doing is we're fucking around. We're doing exactly this. What time is this happening at? Right? Look at your distortion. What time do we actually expand at? So we expand 10:30 to 11:30. Don't take my word. Go into my last lecture and I tell you the highest likelihood for expansion is 9:30 to 10:30. So it's in this window right here, right? Because that's equities open, and that's also the silver bullet algorithmic hour. So if we're going to expand in the day, in the AM session, it's going to be between those hours. We're not going to ever chop around in the morning. Obviously, you guys know that. We're going to expand. We're not going to consolidate. So this right here is the exact same signature we found here. And now we're combining our two concepts. Protraction, where this is protected. Daily protraction. Then a perfect, let me just get rid of all this. A perfect inducement model, right? We're failing to get into the PD array. Again, I'm just going to draw it out using this. It's crude, I know, but just bear with me. Okay. This, right? This fucking around, and this is the PD array, is exactly what I want you to notice, is this. It doesn't have to look clean. It doesn't have to look like perfect engineered liquidity, because this is how price really moves. This is the reality of price, right? There'll often be these stop hunts, and it won't often look like a perfect low resistance liquidity run. But you can recognize on a higher time frame, this is all going to be low resistance. Like this is going to be low resistance here, and it's getting stopped out, and then this is going to be low resistance, and it's getting stopped out. Everything kind of above this high is going to be low resistance, and we will run through it aggressively. Notice, once we actually get the PD array, so once we actually leave the inducement, we leave it, time distortion, we leave the area, you get a perfect setup. And look how, here's another thing I want to show you guys. This PD array isn't respected, and I want you to consider and really reflect on why it's not respected. Then consider this PD array. This PD array is respected. This PD array does hold. It's actually this order block in here, because this is, again, remember, we're looking at discount premium. Just last thing, show it to you guys quickly. Right? The majority of this fair value gap is above 50%. All of this, it's going to come back into the discount level, which is this order block right here. But this fair value gap holds because the stop loss is below here. The reason why this one holds and this one fails is because this inducement model, because this right here. Look at it, and then one more time in your head, look at this, same thing. Then we get a perfect entry. Enter here, ride the expansion. You don't want to enter here? Fine, that's your first entry. You can enter on the next phase of expansion. Look, what is this? A mitigation block right here. Look at the bodies. They are telling you a story, right? Let's draw just these bodies and just these bodies. There you go, mitigation block right here, or breaker block, whatever you want to call it. And they have another entry right in here, right in the PM session. Notice time distortion. Again, can someone please make my night? What is happening here? This is the 5 minute. Let's go up a time frame. What is the higher time frame PD array? Do you guys see it? Again, I'm telling you, this lesson is so important. Okay. What do you guys see here? Forget the mitigation block. You guys don't have to trade it. What is happening right here? Someone tell me. Right in here. It's the same thing that happened right in here. It's aligned with time. The PM session silver bullet. Look at 2 p.m. I'm going to draw a line at 2 p.m. Look where we start the expansion. Someone tell me what this is, please. LRL inducement. Yes, guys, there you go. You get it. Study this video. Study this lesson. You'll get it. Look at this time distortion over lunch. We're retracing. We're not going, look at the 5 minute. We're not going to go long anywhere in here. It makes no sense to go long anywhere in here. Look at this. This is all time distortion. This is this. Okay? Look. Manipulation above the range. Let's see if we get our condition of 2 to 2.5. Manipulation above the range. This is swing low. There you go. I'm not lying to you guys. I use the same shit when I trade. Likely area of reversal, second deviation. Look for a PD array somewhere in here. On the 15-minute, what am I looking for? Oh, well, I see this fair value gap that aligns with this 2 level. I see this massive order block or propulsion block, whatever you want to call it. Doesn't matter. Doesn't matter. These are algorithmically coded levels, as you can see. And this is time distortion. We're inducing because what is the definition of inducement? The definition of inducement return to a premium or discount FVG. That's all you have to know, guys. When someone says, oh, it was just AMD, it was classic AMD, how'd you not see it? Like, I didn't used to see it. I didn't used to see accumulation, manipulation, distribution. I didn't used to see these nice little boxes that people draw on Twitter, and it makes so much sense when you see it in hindsight. Like, yeah, of course this is AMD. Like, how could I miss it? Yeah, I mean, of course it is when you're looking at it 3 hours after the fact, and it looks like this. Yeah, of course. I mean, yes, AMD, I get it. But why here? Why now? And where? Like, 3 questions that you will be able to answer if you can identify this. Look for time, right? This is time distortion in lunch. We're not going to trade into the PD right here. We don't want to expand here. The algo doesn't want to do it. But at 2 p.m. it does. At 2 p.m. it really does. This is the start of the PM session, silver bullet that IST teaches, an algorithmic time. So we manipulate. We manipulate inside of this range before we hit the fair value gap. Once we hit the fair value gap, look how easy it is to get an entry. Look at this. What PD arrays fail here, guys? Look at what's failing here. So, of course, we have, of course you can see it now after the nth example. Yes, LR, failure swings. We're going to run these incredibly hard. This is all going to get absolutely fucking pounded. It makes sense to get pounded because the higher time frame draw, right, on the day, look to the left. Where's the higher time frame draw? Well, it's this high, right? We don't get it, but we get damn near close, and you don't need to capture the whole move. I don't even hold the whole move. I hold for 40 handles, guys. But it's another conversation. So, we're inducing low resistance liquidity. What PD arrays are failing here? Lots. Look, this propulsion block fails, right? This, is there anything else in here? No, I can't find another fair value yet. No, there's nothing really in here. Yeah, nothing. But again, you're noticing this. You're expecting it. By the way, the minute, guys, you see time lining up with this shit, lining up with this first box. Remember what I said? You're going to know it just from the accumulation. So the minute you see time and you see the accumulation in your head, you're going, oh my gosh, I remember XYJ's lesson. We have engineered liquidity. We have our higher time frame discount PD array. Okay, this is looking good. Then we come into it. We induce more traders through inefficiencies. Look, how many of you guys may have, at one point in time, taken this fair value gap as a short position? Maybe. You could. But now you're seeing it in a different way. You're seeing this return to the fair value gap as simply inducement. Because in this fair value gap is where they want to send price higher. Before it, they just want to engineer liquidity above it. Engineer liquidity above it, fuck around, tag into it, boom, AMD. And then the model couldn't be clearer, right? Come into here, displace higher. Oh my gosh. Look at how nice this entry is. You don't want to trade this. This is ass. Sorry for my language, guys. This is shit PA. This sucks. You don't want to trade any of this. Even this move down, this Judas swing in the PM. You don't want to trade it. This is against your bias. And now you're not going to be sucked into trading this because you're going to see it as just this. You're not going to want to trade this leg down because this leg down isn't the move, guys. This is not what the afternoon is supposed to do, right? Again, notice this. In here, we have a false push-up. This is back to Jage's comment about shallow raids, right? The reason why we don't push up from here is why, Jage? This is in a discount of the PD array. What's the reason why we don't push up here? Because remember my original explanation was, oh, well, look, We tap into this 50-minute fair value. Oh, again, here's another example. Here's the shallow raid. Why don't we push up from here, right? Like, oh, because we want to target it later. Fine, we targeted it later. The shallow raid gets ran through again. Why do these lows also get ran? Can someone tell me? Oh, Jay left. Can anyone tell me who's still on? Manip? But what element here is not lining up, PMA? Because price is lining up here. Price is lining up very well based on our concept, right? We're wanting to target a discount PD array. Okay, discount PD array, higher time frame, makes sense. We also had a nice stop hunt of this shallow purge. What's not adding up? Why doesn't this low just lead to this? Like, why? Why don't we just go like that? People do. God, by the way, people entered long here. I remember people entered long here. I remember this day. This was like 2 days or a day ago. And then people got stopped out here and they thought we were going lower. But why doesn't this happen? Why do we do another leg down? Time. Thank you. Yes. Time. Premium discount? Yeah. But look, we are in a discount. Right? Take the dealing range. Here, let me show it to you like as a dealing range so you can see exactly what the levels are. Right? We're in discount. This is in discount right here. We come in discount. Sure, we come deeper in discount here, but why doesn't this push up? This meets the criteria. In fact, this is a really good entry, but it's missing one thing. And that's why I always teach you guys this. And if you guys don't pay attention to the most important part of my lectures, it's always time first. If you notice, I'm always talking kill zones. I'm always talking expansion time as opposed to price only, because here is a dead zone, right? This is all of this in here, guys. To put this in your journal, take a screenshot. I'm not cherry picking this, right? Like we can find hundreds of days like this. This in here is time distortion. Price doesn't want to expand during this time. It doesn't want to. So right in here, during this time distortion, we don't want to be entering trades. We want to enter after the time is optimal. And then look how clean it is. Look at this. Push up. You can hold. You don't have to enter here. You don't just enter blindly at 2 p.m. No, you're going to get an entry model. Look at that 5-minute fair value gap. You want to target 40 points? Go for it. There's your 40. You want to target this high? There's your 50. You want to target 100 points? There you go. There's 100 points. Because you're going to get these movements, these explosive reactions, just like we did on the daily chart. Remember we went to the daily chart and I showed you all those examples of like, oh, same thing, and then boom. And then look, same thing, and then boom. You can expect, because we've accumulated and because we've manipulated below all of these sell stops, that the accumulation, right, of longs and the stopping out of these guys, the stopping out of these guys, and the stopping out of these guys at all 3 times during all this time distortion is going to lead to a huge net long position for smart money. And then this displacement leg tells you now is the time to act. You get in once the market shows its hand, and boom, you ride with them, and you ride with them all the way up. Again, a perfect example of our 2 concepts, right? Delayed protraction, so I can tell you right now that this is going to be a you can add this annotation to your charts, take a screenshot or whatever if you want. This is delayed protraction right in here. It's this range from 2 a.m. I'll put a little bit of I'll put the lines here for you as well so you can see the time that I teach, 2 a.m. to 4 a.m. plus. So we can just go 5 a.m. here, end of London session. This right here is your delayed protraction. Okay, concept 1 integrated, cool. Then we move up higher. What's New York going to do? New York is going to, right, induce some level in the AM session. Perfect. This is exactly the same thing as this. This right here, right, let's draw our time again distortion. When is equities open? 9:30. This is when we want to enter to when? 12 o'clock, so we can just keep that like that. Let's just put this right at noon. Okay, so in here, what are we doing? Before we open, this is time distortion right in here. Look at this. This movement right in here is the same as this movement right in here. It's time distortion. Then, when it's the right time, we get the move. This is the right time. So this is time distortion, and this is time aligned. This is what I teach you guys in all my models. I've never taught a model without time because there is no such model without time. If you don't have the alignment of time, then you don't have a trading model. Right? So time distorts. Oh, look at this. We're fucking around. Put this on your desk, guys. Print it out. We're fucking around. We're fucking around. We come in to the PD array in a time aligned thing. Massive move. So you take your entry on this 5-minute fair value gap. You can target however many points you want. Let's see how many you get. Right? You can get your 40 points right here. Or you can target the swing high, get your 70. You want 100? Go for 100. Same thing in the afternoon. Messing around. Time distortion. Nothing is happening. Don't push buttons in here. If you're pushing buttons in here, you're just impatient. You're just gambling. This is all gambling. Because there's nothing to tell you to go long, right? Because not only do you recognize now this pattern, not only are you saying this higher time frame PD array is the truth. None of this matters. The time frame PD array is the truth. You also know that the time isn't aligned here, so it doesn't make sense anyways. Time aligned, PD array hit, boom. So this is an example. If you want to take a screenshot, copy it, put it in the chat. Yeah, translate and understand your intraday comments better, 100%. Hey, this is how I trade, guys. I don't teach you anything I don't trade myself, and I wouldn't put mine I wouldn't teach this stuff if I didn't actually truly believe in it and trade it. It's one thing to just come here in hindsight and say all this, I understand, but if you know me, I trade this stuff every single day, and I call it out in real time as much as I can. So that's an example of combining our two concepts: protraction, and inducement. Okay, let's do one more example. I'm going to delete all this stuff. I hope you guys took a picture. I put it in the chat as well. We're going to do one more example of protraction to make it very, very clear. And then you guys are on your way. You guys are going to be set to be absolute fucking monsters in the next New York session. Don't trade London. Skip it. So let's do this day. Sorry. Let's mark out our New York opening price. Oh, it's already marked out for us. Okay. So, can someone in the chat please tell me if this is classic or delayed protraction? This chart right here. Remember, midnight till 2 is classic, 2 till 4 plus is delayed. Someone tell me. It's a long lesson. You guys can feel free to drop off if you want anytime. I'll just finish this last example and then we're done. Does everyone see the delayed protraction here? I'm going to assume that's a yes. Right? From 2 a.m. onwards, we are accumulating above the midnight opening price. On the day, take my word for it, we're bearish. If you want me to prove it to you, I can quickly do that. Why are we bearish on the day? Because we're in this premium fair value gap, SIBI, and we want to move from IRL, internal range liquidity and efficiency, to ERL, which is going to be a swing low. So for the day, I'm indexed towards bearish positions, and I only want to be trading alongside that, hence why when I go down to the 15 for my session, I see this and I expect this to now be a protected high. So that's delayed protraction. London is now going to be a protected high. So I will mark this out on my chart and say likely to be a protected high. London high of the day. Tuesday high of the week. This is also combining more concepts. Oh no, didn't go to it. Okay, Monday high of the week. Sometimes you'll get a Tuesday high of the week here. This is going to be on weekly profiles. I'll definitely do a lesson on that as well. Awesome stuff. So, what do we expect New York to do? If anyone's still here and they want to comment. We expect New York to continue or reverse trend. Remember, if London protracts, do we expect New York to continue or reverse trend? Continue, Judas on open, and continue or reverse trend, Pime? Because the one question you have to answer, and the only question you have to answer, is that. Continue, continue. Nice, guys. Awesome. Continue trend. Now you're just stacking your confluences. You already know everything. You already are prepared to win the day. You've already won, guys. You've already won. You're not trading long. You know this is going to be a predicted high. You've seen your protraction. Everything here makes sense. Look at your dealing range. Now you start combining your concepts. That's not a coincidence. This is OTE, guys. 70.5 of the range, right? What are you looking for in the New York session? I have two conditions I taught you in my last lecture. PMA has them right here, right? Go on the hourly chart, mark out the kill zones. I'm looking for a liquidity purge, or I'm looking at a return to a discount PD array. What do I get? A return to a discount PD array. Guys, this is exactly how I trade. If you're at the 3-hour mark of my lecture, this is where the gems are coming out, because this is exactly how I trade. I'm walking you through how I trade and how I get payouts. Just that, right? OTE, premium PD array. I know what the intraday profile looks like. I have an edge on everybody else who doesn't understand what we just did right there. And most people have no idea what this means. They don't see it like this, and you will. Just got to study. This is our fair value gap in premium, right? We know this is a likely point of reversal. That's why I was confident with entering. If you guys look at the chat and Naps the channel, go to my channel somewhere here. I just straight up entered at the high of this fair value gap. I didn't even wait for a confirmation model. I'm not telling you to do that, but I am telling you that if I am willing to just market enter this, you know I must have some more analysis than just being like, yeah, because this looks incredibly bullish. And many people in the chat, if you go to it, on the 3rd, said that high of day might be coming in because they were bullish on the day. But we now have this piece of information. You now have this insight. You know what you're looking for. You see such high confluences with this OTE and this hourly inefficiency. You look at the bodies. The bodies are always telling the story, like I say, right? The hourly closes back within the range. And then you just look for your entry model. And the entry model is really simple on the 5. Right? We sell off. This is high impact news. 10 a.m., right? Continuation of trend from OTE. Here's the model I taught you if you went to my last lecture. 5-minute inefficiency. This is called a low risk entry. And you can enter on the bottom of this 5-minute fair value gap. Yes, you do incur the possibility of drawdown, and the drawdown might be, as much as 100 points. That's why you have to pyramid. Unfortunately, guys, like on a day like this where you have violent news displacement, you have to be able to say, I'm going to take one contract here, and I'm going to DCA here, and I'm going to DCA here, and if I get stopped out, I'm going to lose $250, and my average loss would be something like this, right? So if you get in short here, which you have to, right, the bottom of the fair value gap, then you have to be willing to add here, and you have to be willing to add at the order block. And then you have to be willing to say, I'm risking now the top of the order block and whatever, 40 points, and my DCA actually is like this, so you're actually risking those 50 points. And that sucks. Maybe don't take that trade. Maybe today you sit out. There's more confluence here, by the way, if you came to my last lecture. This is a what? Can someone tell me in the chat what this is? These 3 down close candles? Breaker, absolutely. This is a breaker block, right? This is also a breaker block, right? So this is a propulsion block, or an order block turned into a breaker block that's a propulsion block. This is the true breaker. use the 2 candles. Right? You can use the entire thing. It's up to you. It doesn't matter. Somewhere in here. You can take your entry with the confluence of having the breaker block here. You have your 5-minute entry, your low risk entry, 5-minute frag gap. And you have to kind of be willing. And you also have what I've taught you guys once before, which is called a change in the state of delivery. This is called a SysD. So you have a lot of confluences to enter here, and you can enter. And there's your trade for the day. But it doesn't matter if you don't get an entry, because the whole point is that you knew this was coming, and New York gave you exactly what you wanted to see, right? Then, I'm going to, again, sorry for being long in this lesson. I want to show you that I'm not cherry picking this information. Will you believe me if I said, without looking at this chart, I can tell you there's going to be some form of this model? Because this is how the market books, guys. Inducement, liquidity generation is how the market moves. The market cannot move without liquidity generation. So, mark out your dead zone. You're expecting it now. It's not a surprise to you when I say from 12 p.m. till 1:30, 1 p.m., whatever. Mark out the lunch hour if you want, right? There you go. What is the higher time frame PD array? Let's go up to the 15. Let's check it out. Here we go. 15-minute order block. Okay. Why does this fair value gap fail? Someone tell me. There's 2 reasons why it fails. It doesn't actually fail. The stop loss would be above this candle. But why doesn't it give us the reaction we want? I want to see 2 answers here, and I want those 2 answers to be the 2 answers they should be, because this is the 7th example of why this fails. Someone tell me why this 15-minute doesn't sell off immediately. Again, I'm going to draw it out for you. While you guys type your response, I'm going to give you another template for the same thing we just did. Why does this 15-minute fair value gap not send price lower immediately? I have the answers now on the screen. Time and there's another one. Here, there's 2 things that don't line up. Time's absolutely right. I like the answer of time more than the answer of price, which is the other one. What about price makes a 15-minute gap unfavorable? Inducement? It is inducement. Yeah, premium discount. Okay, so C. What's your full? I can't even see your full. Whoever C is, yes, you're right on both those. Jimmy, you're absolutely right as well. All 3 of those answers are correct. This is this. And I'm not going to show you another example after, because this is 7 examples and you got it. You guys know this now. I'm very confident you guys are going to walk into next week or walk into tomorrow and you're going to see this in the chart. So time distortion happens right here. Let's look at our dealing range to understand why we want to focus on premium discount, right? So everything above this 0.5 is discount. The majority of this 15-minute gap is in what? Discount or premium? It's in discount. The algorithm wants to refer to premium PD arrays for bearish order flow continuity. This is what I call time frame continuity. You'll see it on all time frames. We want to refer from premium to discount, discount to premium, internal range to external range to internal range. I am a broken record, but notice the OTE, right? Not a coincidence as well. But this order block is what I would have marked out. It makes more sense for me to have this marked out. Doesn't mean you can't mark out the gap. The gap's also good, but the order block is in premium, so mark it out. Time distortion. We don't have time aligning. Now we have the PM session, right? 12 to 1 is lunch. Sometimes it can go all the way till 1:30 or 2, right? But as you can see, the daily draw, if I go to the daily chart, the daily draw is the low. So I'm going to have it marked out because we're going, maybe like this low, or even this low. Let's say this low, previous day low. We're going from this daily inefficiency to a daily low. Actually, the real draw is down here, but you'll take a partial here, obviously. Why wouldn't you? Okay. Now you see at 1 o'clock, right? price is starting to expand away. So you can understand that time distortion has ended. Why? Why is this time distortion? Because we're not, look at this. Guys, look at how we're not touching the fair value gap. Like, take a picture right now. Look at this. You will see this every single day. Look right here. And then look right here. Right? Inducement. This is inducement. Look, we're not tapping the order block. That is the target. What are we generating? Right? What is this? LR, LR. That is the signature I'm looking for. LR, LR. Engineered liquidity. Money. This is money beneath the marketplace that we are expecting to get ran once time distortion has ended. Time distortion ends. We get our run on LR, LR. Your entry model can be up here at this order block, right? You can take it on the 5-minute, or you can wait for another confirmation, which could be. Entries don't matter, guys. I hope you're seeing entries. I don't teach you guys entries because you don't need to know entries. Who gives a fuck about entries? You are going to be able to see price, and once you see price, like it's going to open up. It's going to open up all these like possibilities. You're not going to care about your entry because you'll be comfortable entering here, right, at this breaker block. Right, price trades through it, activating the breaker block, trades back into it. It doesn't come into the fair value gap. It doesn't need to, right? It comes into the breaker block. This is enough. You can add another contract if it comes in here. Give yourself a nice unicorn setup. It doesn't matter. That's a valid entry. You don't get that entry. It sucks. You don't have to worry about chasing price because you understand order flow. Now you're synced in. You're synced into order flow. You get it. What is this? A mitigation block, right? Okay. Trade through it. Here's the entry. So you could add here. Like, let's go through all the entries we could have. The 5-minute order block is a really nice entry. After time distortion ends at around 1 p.m., when I see displacement away, right, on a lower time frame, yeah, you can enter somewhere in here. It doesn't have to be like a fair value gap or anything. You can just say, okay, I believe time distortion has ended. I'm willing to risk 20 points for a greater R, and you can enter there. Okay, say you want a confirmation. Absolutely fair, especially if you're trading on a new PA, whatever. Here's another valid entry. What are you risking? Same stop. Now it's 30 points. What are your targets, by the way? Oh, your targets are this. It's this slow. You don't need a partial. You don't need to. Today I didn't partial because it's this slow. Obviously, you're not going to hold for 109 points without partialing because you don't have trust in the model yet. And also, it's NFP week, so price can do weird things. So take it here. 50 points, 60 points, but hold the runner. Definitely hold the runner. Okay? You missed those entries. Where's the next entry? You're synced into order flow. You don't care about, you're not chasing. This is not chasing price. When people say this is chasing price, that's absolutely categorically wrong. This is not chasing price. This is where I'm adding. I will add a contract here. I will add a contract here. I will add a contract here. I start with 2 micros, and sometimes I work my way up to 8 micros, but I don't do it by averaging down. I average up. Okay. You can add a contract here. There you go. There's your whatever. Now, once you're getting in to below this level, now you're looking at short-term discount. So now this is a riskier ad down here, right? As you can see, price slows down, retraces, but your original entry is still holding, right? And then eventually we deliver. When do we deliver? Of course, you know it's time. So if you do use quarterly theory, I heard someone talk about that earlier, right? This is a concept I don't want you guys to try and combine. You don't need it. Okay, here, manipulation cycle. Lines up pretty well with this thing in here, right? And then sell off. And to make things better, there's no real inducement level here. It might, on a lower time frame, there might even be an inducement model. So this might look something like this. But again, manipulation here, if you use quarterly theory or you just think about manipulation in the market. And then delivery. You don't have to chase this anymore. You don't have to chase this LR being built up. You can add, or you don't have to fear you're going to get stopped out. Say your position and your stop loss on this entry is above this high. You don't have to just like randomly stop yourself out here because it's coming back against you. No, like you are now in sync with order flow. You're gonna understand that you want to hold to here and it's gonna deliver. So those are two concepts again, right? Same day, delayed protraction, likely high of the day, classic sell day. So a classic sell day involves this. I'll write it out for you. Classic, whoops. There you go. This is your ICT classic buy and sell day. So this is in core content month 7 or month 8. Don't quote me. I'll have to pull it up on my Notion later. But this is classic buy and sell day, one of the intraday market profiling guides I teaches. So London high of the day, protraction, and then New York OTE continuation. Both conditions met, right? Literally, OTE I think is met here to the tick, which is crazy. Yeah, right, 70.5. So that is the lesson. Anyone have questions? This is probably the most this is probably the best lesson I've made besides the MMX one. That one's my entry model. So if you want to learn what the entry models I take are, then go to my last lecture. If you want to know how I see a daily profile, then go to this lecture. And in the future, I'm going to teach you how I see a weekly profile. So when you combine the weekly with the daily with the entries, you're going to have something really like robust. Let me turn off the stream.